investors, welcome to the Macro Real Estate Investing Show. I'm your host, George Gammon, and this is the show where we look at the headlines from the world of macroeconomics to determine how the news applies to real estate investing. My goal is to help you stay informed, make better decisions, and of course, make more money. So let's dive right into it, guys. Holy cow, Monday we had I don't want to call it a crash, but the Dow was almost at one point was almost down 1,000 points. It ended up down about 780 points for the day. I believe it was the greatest drop in the Dow in 2019. So we had a lot of headlines coming out from number one, Trump. He increased the tariffs on the Chinese, which we talked about in the last video. But then the Chinese came back out and they manipulated. Well, I'm not going to say they manipulated their currency because although that's kind of the narrative that you hear in the media, and that's the narrative that you get from the government, that's not exactly what they. In fact, it's the complete opposite of what they did. They were actually manipulating the currency up. They had it. It was above 7 Yuan to the dollar, and they were keeping it at that rate. If what they did to take it under that 7 per dollar mark, which is kind of that line in the sand that's so important for both economies and the world economy, is they actually just stopped propping it up and just kind of let it float a little bit more, and its natural position is lower than 7 Yuan to the dollar. So it's a really a misnomer that you hear in the media and by the government to say that it's labeling China as a currency manipulator, as if they are holding their currency down. They're actually holding their currency up, and by letting it go, that is what actually dropped it below that 7 mark. And of course, when it goes below the 7 mark, then of course, Trump comes out and all these other knuckleheads and says that that's because China's manipulating their currency. It's actually quite the opposite. So some of the guys that I really listen to and follow, Kyle Bass being one of them, he's an expert on China, and he's actually suggested that if the yuan, which is the Chinese currency, was free floating, it would actually be about 30 to 40% lower than it is right now. So that is what that was the main catalyst that took the market just plunging down on Monday. I wanted to also kind of on the same note discuss gold and to review gold quickly here before we get into how this pertains to real estate investing. So you've got markets, I don't want to say they're in turmoil, but we've definitely seen volatility come back to the markets. So let's look at gold. And hopefully this is a chart. Come on, where are my charts? Right here. So here are my charts, and you can see, let's just go back to 1 year right here and look at these charts. If you know anything about technical analysis, and I won't go in, I know quite a bit about it, and I won't go into it, but this, from a technical standpoint right here, is extremely bullish. I mean, when you've got this move, this chart going down a little bit, coming back up past its prior peak, and then coming up with probably a lot of volume, looks like a lot of, and then kind of consolidating right here, and then coming back up past its prior high. That looks like a very, very strong chart to me. So gold has gone up as of about a year ago. It was right around 1,200, and now we're at the almost the 1,500 mark. So that's a substantial move in gold over the course of a year. Why do people buy gold? Well, they buy gold. Sometimes they buy gold as an inflation hedge, but the majority of the time, the reason that people buy gold is because of uncertainty. And when things start going to hell, if you will, gold is always considered a safe haven. For 5,000 years, it's been a safe haven, and it will continue to be a safe haven. So if you look at what's going on in the market, if you look at what's going on between the United States and China, where they're getting into this not only trade war, excuse me, but now they're actually getting into a currency war. And then you combine that with what the market is telling us about, or what the gold market is telling us, and you see that we are right now in some very, very uncertain times. So how does that apply to real estate investing? That applies in the sense that I don't think people are going to be going out there and dropping 20, $30 million on mansions in LA, or $30 million on condominiums in New York. I don't think you would see that for as far as natural demand. The only reason I think that you would see that at scale is if people like the Chinese, an example, were just trying to get money uh, out of their country and just find some place to park it that's going to pay them anything, a decent yield, and is safer than holding it in the bank, or giving you a better return than the 15 trillion in negative yielding interest rates that are out there for sovereign debt, which is generally a safe haven. So my point is that if I'm a real estate investor in the United States right now, if I have to own USD assets, which I suggest everyone owning, especially if you're in the United States, I strongly suggest having at least 50% of your portfolio denominated in US dollars. So if you're one of those people, I would really hesitate to invest in properties over $500,000. I see a lot of downside there. And now that's not to say that the market can't go up, that they can't double in price, that even in real terms, adjusted for inflation, that they can't go up. If interest rates go to negative in the United States, they absolutely can. I'm just talking about your downside risk relative to your upside risk. And remember, one of the pillars of my investment framework is I don't want to look at possibilities. I want to look at probabilities. So I just see a lot of downside there, and I don't see a lot of upside there in the real estate market 500 plus. Where I do see opportunity, like I've said many times, is the only asset right now that's cheap, and I consider it an asset, is debt. It's 30-year fixed rate debt in the United States. So that is cheap. That is dirt cheap. And you say, well, George, what if interest rates are going lower? Fantastic. They go lower. They just refi at the lower rate. It's absolutely a no lose situation. So then the next question becomes, okay, well, what do you buy with that 30-year fixed rate debt? Well, what you have to do is you have to try to find the least risky asset that you can purchase with the least amount of downside to take advantage of what is cheap, and that's 30-year fixed rate debt. So my suggestion there would be going into a linear market, the Midwest. Of course, as most of you know, I really like Kansas City. I've got a lot of properties there. I've done a lot of investing there. But Indianapolis, Kansas City, St. Louis, Nashville, Memphis, Little Rock, there's excuse me, there's several of those little markets like that I think are fantastic, that really don't have a lot of appreciation, but they really don't go down too much in a downturn, and maybe there's less credit in those types of markets. So that's really what I suggest doing. And I think the more we look at what's going on in the stock market right now, the more we see uncertainty in the world economy, the more we see negative yielding interest rates, which implies a lot of uncertainty. The more we see gold with a chart that looks like this, that's gone from 1,200 up to 1,500, and it doesn't look like it's stopping anytime soon, that implies that there's a lot of fear in the markets, and things could be getting worse from an economic standpoint. And that's when I want to own 30-year fixed rate debt and starter homes that you can buy in linear markets for under the cost of construction. I am not saying that those are going to appreciate massively. What I am saying is that's where you can park money that has the least amount of downside for capital preservation and to take advantage of what is cheap. That's 30-year fixed rate debt, and then also get a yield from that. When you compare that to all your other options out there, to me, it's just a complete no-brainer. So let's go on to my next point for today's video. And this is something I thought was really cool. If you haven't gone to this website, I'd strongly suggest it. It's visualcapitalist.com. And let me move my head here. My head always gets in the way. So the cost of rent in 140 plus North American cities, and it's done visually, obviously, hence the name Visual Capitalist. But really cool, isn't it? How you can the bigger the circle, the higher the rents are. But one thing I wanted to point out here, right at the top, was the increase. So rent as a share of income is on the rise across America. Back before 1987, we had 25% of Americans, or 25% of the annual budget or income for most Americans went to rent. Now that is 30%. You say, well, I mean, it's only 5%. That's a huge amount of someone's annual income to be allocated to rent, or a huge increase. So rents, in addition to prices, are going up, which is, I have not studied this. I've not studied charts, but it seems very counterintuitive, because as property gets more expensive, it gets cheaper to rent. And as rents go up, it gets cheaper to buy. So there's almost kind of a inverse relationship there that you would think. But for the last 10 years, prices have been going up and rents have been going up. Or excuse me, not for the last 10 years, probably for the last 7 or 8 years. But prices have been going up and rents have been going up. Well, at some point, that's got to give. If people's incomes aren't increasing at the same pace as rents and home prices or mortgage payments, something's got to give there. So I know I go on a lot of investor forums for real estate investors, and a lot of these guys are super sharp and have a ton of experience. Their argument is, if home prices go down, well, that's great for them because rents will have to go up. And I don't know that that's true, because, again, they're already so high that people are having to think of creative ways to actually afford to live. And so what I do is I look at Europe, and I think this is tough for Americans, because Americans have such a U.S. centric view of everything that they really don't understand how the rest of the world lives. And in places like Europe, the spaces are just a lot smaller. And in places like South America, the spaces might be the same, but you got 3 generations of family living in the same house. It's paid for. I mean, only 3% of Colombians, as an example, have a mortgage. 3%. So that means that the majority of the homes that are in Colombia, the family or whomever owns it outright. There is no